Good morning, all. I'll give you the context of this presentation. We, on an annual basis, scan our eyes across the top 50 listed companies in Australia, and what we do is pull out all of the debt and capital management discussions that these top 50 companies have through their investor presentations. And it also combines with our own experience in our, on our day job. And what we do is pull those observations and try to summarise the key themes that come out of those. And we are going to give you a flavour of those. My own observation is that, pre-GFC, trying to get a board to talk about particularly debt management. Right, they did talk about capital management, but debt management was something which you really didn't see too often. However, times have changed significantly, and everyone really wants to have a discussion around debt management and capital management, and we've certainly seen that come through the surveys as well, or the analysis that we've undertaken. So we are going to be covering both the ASX top 50 companies. We're also going to be looking at, so we're going to just share some of the extracts from the investor presentations that forms part of our work. We will also then look at, from a macro point of view, what these companies have, what they've been trending in terms of their payout ratios and their balance sheet structures over the past 10 years or so. And this year we also looked at the Dow Jones companies as well. So we had a quick check across to the US and sort of just compared that to what Australian companies have been doing. So the top 7 themes that we observed are what we're going to be talking about a bit more, and really you can look at those into 3 broad categories. But one is the focus on cash optimisation, and it's in the context that from a macro point of view, we've seen a very benign world economy over the past 6 years or so, and it's therefore made top line growth very, very challenging. And as a result of that, a lot of companies have been focusing on cost management, very, very prudent capital expenditure management, making sure that capital expenditures have been returning at the appropriate returns, and really a lot of focus on that optimising cash in the absence of top line growth. The second key category that you'll see within these 7 themes is around, with that increased cash, very much a focus on returning that to shareholders, very much a yield play, or returning capital, very away from the days where perhaps making capital returns or giving excess cash to shareholders was seen negatively by institutional shareholders in particular as a sign that the company did not know what to do with that cash, and that they should have really been ploughing that back into the company to attain more of the capital appreciation for the shareholders. And the third aspect is around a lot of discussion around debt management and really maintaining for either credit rating or certain credit ratios which really track to a certain credit rating equivalent, you could say. So they're the main themes, but we're now going to go through and just give you examples of, and these are just snapshots of from the investor presentations, and certainly the theme on this slide or the next few slides is around this rigorous investment return analysis, or communicating to shareholders, demonstrating that they are focused on optimising returns on each of their businesses. I mean, this one is from Wesfarmers, and it's really the focus of return on capital, and comparing that in other instances, as you'll see, with their weighted average cost of capital. Because if you are making a higher return on your capital compared to your cost of capital that is adding economic value to the firm, and therefore shareholder wealth is appreciating. And certainly in this slide, where with Wesfarmers, they go down to the individual business level, and have always been very, very disciplined at communicating how the returns that they are receiving from each of the asset classes that they have, or each of the operations. On this slide from Coca-Cola Amatil, you'll see that direct comparison, that top line, if I can use this pointer around there, where it's comparing their return on capital employed directly to their WACC, and demonstrating the discipline and the consistency of them being able to monitor their businesses along those lines, and the resultant outcome of this discipline that they have within the company. And this is another example which was taken from Woolworths, with the return on funds employed, and over there they've of course are investing a lot of money in the Masters rollout. So within that there are some adjustments made, but once again it's that continual focus of management, and you certainly can see that's an important KPI for them, right? So on the next aspect, so that was really demonstrating that I guess investments that are made, they are monitored, and that the returns are being made. And as an extreme example, now probably about 2.5 years ago, when BHP was announcing that it was interested in making a very large acquisition in the US, there was a quite substantial shareholder revolt, to the extent that shareholders certain institutional shareholders, had threatened to not re-elect certain non-executive directors that were coming up for re-election, because the shareholders felt that was a too much of a risky transaction, and that they'll rather have that surplus cash returned to them in the form of capital returns or surplus super dividends, special dividends being made. Once again, something that wouldn't have happened pre or more during the high growth economic environment that we had. And certainly on this one with BHP, there was a lot of emphasis. This is right in the middle of the mining boom as well, but nonetheless, very, very strong focus on maximising internal cash generation through cost management. Now this one, we're on Wesfarmers, and you saw this with Amcor as well, where they've undertaken a lot of working capital initiatives, and they're not so much let's just tighten our payables and receivables. They're really going through the manufacturing processes, their logistics chain, and really getting some long-term sustainable changes in their working capital. And once again, it's to free up that capital and then to return it to shareholders. In essence, was the theme of these discussions. And there's one here in relation to Orica as an example of almost highlighting that the capital expenditure profile going forward was going to be reduced. That is, there was going to be more cash retained in the business, and certainly in the top 50s, Orica is just one example, but there were many other examples of companies where they were almost upselling the fact that they were going to be spending more on capital expenditure. And this one's also the BHP slide. Once again, their focus there is on a decline in their capital expenditure, just to demonstrate that, albeit volumes are very, very large there. All right, I'll now hand you over to Georgina, and then you'll see me a bit later on.
Thanks, Matt. So certainly one of the other themes that we've seen coming through the ASX 50 reporting season has been around opportunistic replacement of funding, and borrowers have been taking advantage of favourable market conditions for a range of reasons, to reduce interest margins, extend maturities, improve the terms in their documentation, and also to diversify funding sources. So this particular example of Horizon, you'll see the second bullet point, they refer to the fact that the debt margin under their new facilities reduced by 35 basis points, and they've extended their tenor out to average 3.6 years. They did a transaction last year, in May last year, a $3.6 million transaction, so quite a sizable deal in the market, where they accessed 3 and 5 year funding. So certainly this is an example of a company that's reduced its interest margins and extended its maturities. Another example here is Origin. So Origin once again accessed the market in 2013 in September. It did a jumbo transaction, $7.4 billion in the market. Really a great sign of good conditions. I mean, that deal had capital markets bridge, it had 15 banks coming in the early bird phase. These are all the things that indicate conditions are good. I think a key point in relation to Origin was certainly what they did was their previous documentation was negotiated in 2004. So they used this transaction as an opportunity to improve some of the key terms. And when we say improve, certainly taking advantage of good conditions, but also making sure it's a good fit for their company so that management are free to run the business as best they can. So what we're seeing ourselves in clients that we're working with is that they're seeking improvements in financial covenants. So the interest cover ratio, they might have a gross currently and they might replace that with net interest, for example. Increasing flexibility around acquisitions, event of default around reduction of capital, allowing for buybacks, those sorts of things. Looking at the permitted financial indebtedness clause, whether some additional flexibility can be provided, and even definitions such as EBITDA, where there are adjustments for asset impairment or excluding asset impairment. And then the third example of opportunistic funding replacement relates to diversification of funding sources, and here we've got Fortescue who accessed the Term Loan B market, and I think this is particularly relevant in that a number of Australian corporates have successfully accessed that market. We've seen Hoyts, Spotless, Alinta go to that market, so certainly it's a good alternative for the right company. Another theme that we've seen coming through the reporting season for the ASX 50 is in relation to capital returns. Certainly remains on the agenda, and it's been evidenced by share buyback programs and increasing dividend payouts. Here we've got Transurban, and you'll see that what they've provided in their reporting pack is an analysis over time from 2009 out to 2014, showing the compound annual growth of 9.1%. We've got Horizon here again. Under their dividend, the fourth point on this slide and the key highlights, they actually state that their dividend guidance is changed and the payout ratio increases from 50% to 60 to 70%. And the third example of this is CSL, who's had a good level of success in terms of a 900 mil buyback, which was completed, as well as accessing the US private placement market for 500 mil. Another key point coming through the reporting season has been maintenance of credit rating, and there certainly is a commitment to maintain an investment-grade credit rating, and that remains a priority. 38 of the 50 ASX 50 actually maintain investment-grade credit ratings. And to me, this is around access to liquidity, right? If you're big, you want a range of options. On this particular slide, which is BHP's slide out of their reporting pack, you'll notice, and this is actually from their 2012, but we particularly like it because it's just a very interesting highlight around the credit rating point in that, so their priorities here are, first priority, invest in high return growth opportunities throughout the economic cycle, but their second priority, which rates ahead of dividends, is to maintain a solid A credit rating. And Telstra has a similar theme here on this slide, where actually under their principles, they state the first principle being to maintain balance sheet settings consistent with a single A credit rating. And we've also included here a couple of slides from Asiano, and what they do is they look at both leverage range and interest cover to show the metrics over time, and particularly they look at their lease adjusted EBITDA to interest and FFO to debt and show that movement over time. And I think the reason behind this is they have a split rating, and they're certainly in this particular slide they're making it quite clear that they see that they meet 2 out of the 3 criteria for a ratings upgrade. And the last theme that we see coming through relates to improving debt maturity profile spread, and that's around tenor, but it's also around funding source. So here we've got CSL, and CSL show their debt maturity profile in a pre-US private placement environment and a post. So clearly undertaking that US private placement has enabled them to spread out their maturities a little more and lengthen those. And here we also have Toll, and Toll they show their debt maturity profile over time, but they also show a split across product. So they've got bilateral loans, syndicated loans, and a US private placement. So once again, they're highlighting that they've got a good spread across tenor and across sources of funding. And the last company to note in this regard is Telstra. And Telstra highlight here in the table on the left, they talk about their average debt maturity, which is five years in 2012, and that they've shifted that out to 5.5 years in 2013. So they're highlighting the point that that they've lengthened that and that it's important to them. So I'll now hand over to Matt, and he's going to talk about what we've seen historically in terms of dividend and debt ratio trends.
Thank you, Georgie. So now we're taking more of an aggregate look at these top 50 companies in terms of their payout ratios or payout activities, and I guess mentally you would all when asking what's an appropriate dividend policy, I think most of us would think automatically that a 50% payout ratio seems to be about the norm. So that was definitely the case 10 years ago, but you can see that that's more moved up to over 80%, and you even saw it through one of the slides, and I can't quite remember now which one it was, whereby the company had announced a 50% payout ratio, moving to 60 to 70%, and certainly it's a very common theme, and so even in aggregate, you see on the right hand side, that's was almost a bit of a cross check to see that the payout ratios do translate even to an aggregate dividends paid. Just go to the next slide. On this slide, what we look at are the aggregate, total debt to capitalisation ratios, which is capitalisation is debt and equity combined, EBITDA to interest and total debt to EBITDA. I guess when I saw some of the interesting observations that I make from the top 20 companies, top 50 companies around the EBITDA interest cover ratio at pretty much a high 20 times type of cover, I was actually interested that the total debt to EBITDA, or EBITDA to interest, I should have said, was around the 20 times. But in total debt to EBITDA, you're looking at around the 2 times level, which to me seemed a bit too high. But then there are certain companies in our top 50 companies, such as APA, I should say, Fortescue, Transurban, more of those utility-like or mining that do have a very high debt to EBITDA, which then tend to keep that average up. So next year we're going to adjust this and have more of a industry split up as well. In terms of just quickly going through the top 50 companies, and I'll just skip through these, but the main messaging around the US Dow Jones companies, that really represent the top companies in the US and probably globally as well, is that their themes were very, very similar to Australia's is the main aspect. So, we shouldn't be surprised because we are in a global capital markets. Australia companies do participate in the global capital market, so that they should be that similarity, and that's come through pretty strongly in terms of the top 8 observations that we made for the Dow Jones companies. For the aggregate statistics, so something slightly different, and that is that the payout ratios in the US, although trending up as what we've seen in Australia, it's not at our 80% level, but rather than 60%, and that's because of our franking credits system in Australia. We do tend to pay higher dividends rather than capital returns, whereas in the US, the tax structure there, particularly through franking credits, means that most of that, a lot of those excess capital returns are done through share buyback activities. To me, interestingly, the bottom right hand, you're looking at the total debt to EBITDA hovering at around 1.2 times. Ours, we recall, was around 2 times. And once again, you sit back and reflect, well, wow, geez, and does that mean that we are too highly geared here? But the other aspect of this is that with the US, with the Dow Jones, that I think are the top 30 companies or so, or selectively, they're not necessarily top 30, but they get introduced through a criteria process. There are companies that have multi-billion-dollar debt portfolios of, $50, $100 billion debt portfolios, which they need to make sure that they're always, tracking it more like a single A and above credit rating, so that they've always got access to the capital markets globally. So to me, and they are somewhat perhaps takeover proof because of their size, so they're able to maintain much more conservative, very conservative balance sheets as a result of that. Having said that, I just noticed over driving in this morning that Rupert Murdoch's making a $90 billion takeover bid for Warner Brothers. That's phenomenal. can't get my mind around that. And that's our team. So that's it from the areas that we want to cover.